Hey everybody, it's Daniel here from Infrares. Hope you're all doing well. So, we got the FOMC minutes that came out today. These minutes generally come out after the main event, the actual meeting that happened just not so long ago. And these minutes basically summarize the FOMC's views. It goes more into details of since that last meeting, what majority of the participants think when it comes to monetary policy, interest rates, rate hikes, growth, labor market, GDP, etc., etc. Right? So it's not crazily a market moving event because it's just a document that comes out just summarizing everything that we already know. However, sometimes it does cause some volatility when it comes out for a short period of time. And yes, sometimes it's possible they could update it with some new information, maybe, right? But generally it tends to be the same as what we've heard from before. So the main theme that came out from the minutes is that they're proceeding again. They use the word caution, right? Participants are cautiously proceeding, right? Whether they should continue hiking rates or not. So the key word is there's caution, right? And like we've heard in its last meeting, the FOMC's last meeting, is that they used the word of caution, which kind of gave a dovish tilt in the markets, and thus you had stocks and bonds rallying, right? So the fact that the minutes came out even with the rally we had in bonds, the yields have come down. It's interesting that they kept the tone, the narrative the same. So basically hinting that, again, they're probably done in terms of hiking rates. Very, very low chance of a rate hike in December. And they're just going to continue to assess how the situation comes out. Now, I'm just going to read a couple of points here just to summarize. So all the participants, so these are summary of what all the participants think in the committee. And basically they said, all the participants basically agreed that monetary policy should remain restrictive until inflation substantially moves towards committee's objective, hinting that, don't think we're going to cut rates anytime soon. We're going to probably, even if we don't hike, it's going to remain higher for longer. It's going to remain here for some time. And that's very common in when you see these cycles, especially during a pause, after raising rates so aggressively, that the pause tends to be 6 months or maybe even a year, right? They basically also said all participants judged maintaining the federal funds rate at the current level. So that's they view it as that's appropriate. All the participants agreed on the necessity of reducing the Federal Reserve securities holdings. So they're still doing QT. They're still rolling off the balance sheet or tightening there, which means that they're not buyer of bonds, which basically means that if they're not buying bonds, then they're not bringing the rates down from that point of view. So in fact, that they're somewhat keeping the pressure on the yields, the bond yields, to be up, right? They also agreed that every policy decision should be based on incoming information and its implications for the economic outlook and risk balance. So again, data dependent. Is inflation going to come out higher? Is it not? Last inflation report was not so bad, caused equities and bonds to go up crazily, right? And we're seeing that rally continue. So again, depends on the information that comes out, depends on how the labor market's doing. According to that, they'll make a decision. Like we saw, continuing jobless claims start to inch up. Even though we have yet to see the true damage in the job market, but there's signs that, there is weakening happening, a weakening happening for sure. Now, those are what all the participants felt. Now, let's get into what most participants feel. Not all, but most. So most participants feel that continued to see upside risks to inflation, including potential prolonged imbalances in aggregate demand and supply. So they said that, that fits with the higher for longer narrative. We're going to keep rates higher for longer because we see risk that inflation could be sticky, could be, higher for some time. And especially like I did in my last inflation report video that I talked about. It was 30 minutes long. You can check that out. Basically breaking down, going over that, yeah, if you look at the super core number and you take out all the important items like rent, housing, right, food, all of these things, then sure, your inflation report looks better. So the super core number takes out the housing, the rent component, leaves basically services in there. And yeah, sure, that's why you're seeing the super core number come down, inflation number come down. And yes, the report was better than expected. But if you look at certain components like the shelter, like the rent, housing, food prices, food at home, food away from home, they're still high up there. They're still creating pain for a lot of consumers. So it is still sticking around, especially with wages not dropping off aggressively. You can see that there's still factors that can feed into the stickiness in terms of the inflation. Now, many participants commented on the significant tightening of the financial conditions due to higher long-term yields. So, okay, those yields in the bonds that went up, that created some tightening. But what about now, right? What about the fact that yields have now come off, right? Does that mean that, we need to start tightening again? Maybe, maybe not. Many participants observe the contribution of term premiums to the rise in longer-term treasury yields, noted downside risks to economic activity, including larger than expected effects of tightening financial credit conditions. So they said, okay, the bond market kind of did its tightening there. Is that enough? That's the question. If it's not, then, next year, if inflation is not coming down, the economy is still fine, then they could be talking about maybe keeping rates higher for longer, for much longer, right? Because you got the markets now pricing in that rate cuts are coming for sure in June, right? June, July, we're going to see the rate cuts. In fact, that, you got the markets pricing in that rate cuts could even start May. But definitely the markets are pricing in that definitely you're going to see the cuts in June, July, right? Why? I mean, maybe hard landing, right? Several participants noted potential cyber risks and the importance of readiness for such threats. Commented on recent decline in the use of the on-RRP facility, emphasized the importance of the banks being prepared to use Federal Reserve liquidity facilities. Some participants, not all, but some noted benefits for businesses from improved hiring ability, supply chains, reduced input costs, reported difficulties for businesses in passing on cost increases to customers. That's why, you'll see that some businesses will fall or maybe even go bankrupt because they can't pass on that cost, because customers are saying, hey, I can't buy this, so I'm going to go find a cheaper alternative until you bring your prices down, right? It's a full cycle, right? You can't keep up with this, especially if you got loans and debt that's coming for renewals next year. And as a business owner, if your cost is expensive, your debt is getting more expensive, you're trying to put it in the goods or the services that you sell, right? But mostly goods. It's very difficult to do that. So what are you going to do, right? You need to get it off your shelf. You're going to reduce the prices, which might help with the inflation reports, right? And obviously, if things get really worse off, you can expect a lot of companies out there to start reducing their prices and doing it even more aggressively there. Another thing that was discussed, the importance of monitoring treasury market functioning and hedge fund leverage. Very interesting. Few participants said that how the treasury market is functioning and how leveraged some of these hedge funds are. If they're massively short and we get a massive squeeze, right, or if they're massively long and they gotta liquidate, right. Any problems there, they want to continue to monitor, because if they have to liquidate and sell aggressively, that will cause yields to really shoot up and skyrocket hard. Not expecting that to happen. So that's from few of the participants. Some participants highlighted challenges for small businesses due to tighter financial and credit conditions. So here's the thing. In America, small medium businesses make up for most of the jobs out there. I know it's crazy to think that you think that big companies are the biggest employers. It's actually small, medium-sized businesses there that employ majority of the people out there. So if they're going to get hurt and hit during this time, which they're feeling the pain, you can expect that translating later on down to the labor market, right? And possibly that unemployment rate or whatever moving up higher. Now, few participants noted nominal wages still rising at rates above consistent with 2% inflation objective. That's not a good thing, because if you got wages continuing to be higher, especially and it's consistent, that creates stickiness in inflation. It's very hard to bring it down unless those wages stop or maybe even decline, right? Few participants expressed concerns over the recent pace of increases in labor supply, discussed importance of monitoring treasury. I mentioned that. Observed that the process of balance sheet runoff could continue even after reducing the federal funds target range. So very interesting here. You could get a scenario where the Fed is cutting rates and they're still running off the balance sheet. They're still doing quantitative tightening. So you're kind of getting this little bit of a balance where they're cutting rates to ease a little bit here, but then they're still selling, getting rid of their bonds, which is pushing the yields high. So does that balance things out? I mean, that will be interesting to see when the time comes and when that happens. So, very interesting that you would see them do QT while cutting rates, right? So you would think that they would stop QT completely, especially when they're cutting rates, because when they start cutting rates, you begin the easing cycle. So easing means that you shouldn't be running off the balance sheet or doing anything there. You would think that you'd be maybe even buying bonds, right? Or not buying at all and not selling at all, keeping maybe neutral. So very interesting that they noted that, because if, let's say, the markets are right that they're going to start cutting rates soon next year, they might start with little bit rate cuts, right? Continue the QT, see did they break anything, and then if not, right, they may hold rates, right, from 5 to maybe 4%, continue the QT, and then if something really breaks, let's say by the end of 2024, start of 2025, then they can start really aggressively cutting the rates, stopping the QT, and maybe start that cycle of QE and start buying bonds and back to stimulating the economy again. And that would all be on if this is in a credit event scenario, in some sort of big crunch, big crash that causes something to break and they need to step in. Federal Reserve needs to step in and do something about it. So pretty interesting there. So overall, what do I take from this whole minutes thing is that they sounded the same as they were before, tilting towards more on, you could say, the dovish side of things. Lifted stocks and bonds temporarily there. But again, nothing major, just other than that they're proceeding with caution and they're in pause mode right now. And after pause mode, unless, things get hot in terms of the inflation and growth and data and whatnot, things are looking fine. If that doesn't happen and you get continued weakness, then you know what, they can start moving towards thinking about cutting, and they could start it, right? They don't have to cut aggressively. They could just do a little bit and then assess the situation, or not cut at all, but they can start it if they really perceive that down the road things are going to get worse off. And this happened very similar to back in 2007 when they started to cut a little bit, and then 2008 came and they started going aggressive. So you could see the same layout. It'll be interesting. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.